What if I told you that one stock exploded by 123% while another grew steadily at 34%? And what if the explosive one might actually be the riskier bet? I'm Smart Stock Sam, and today we're diving deep into something the market is currently obsessing over: SMCI versus AMD. Which one deserves your investment dollars right now? Stick around because by the end of this video, you'll know exactly which stock fits your portfolio. And trust me, the answer might surprise you. We're comparing two titans in the AI infrastructure space. On one side, we have Advanced Micro Devices, a company that's been around for decades, battling it out with Intel and NVIDIA. On the other side, Supermicro Computer, a relative newcomer to the spotlight, building the physical infrastructure that powers AI data centers. But here's where it gets interesting. These aren't just two tech companies. They represent two completely different investment philosophies. Think of it like this. AMD is the architect, carefully designing the blueprint for the future of computing. SMCI? They're the contractor racing to build as fast as possible while demand is hot. So let's talk numbers. AMD posted a 34% revenue growth in Q4. Solid, right? But SMCI, they absolutely crushed it with 123% growth. Now, before you rush to open your brokerage app, let me ask you something. What matters more, speed or sustainability? Because that 123% growth comes with some serious caveats. The market isn't just about who grows faster, it's about who grows smarter. And here's the thing that keeps me up at night. SMCI's growth is almost entirely dependent on the AI infrastructure boom continuing at this breakneck pace. What happens if it slows down even a little? Here's what really separates these two companies. SMCI captured what the market calls the pull-through effect. They're not just selling GPUs or chips, they're selling the entire rack: cooling systems, networking equipment, power distribution, and yes, the GPUs too. So when a hyperscaler like Meta or Microsoft wants to deploy AI infrastructure, SMCI can do it in weeks instead of months. That's their superpower. But here's the uncomfortable truth. This business model works beautifully when demand is exploding. But what happens when it plateaus? AMD's approach is different. They're building diverse revenue streams across data centers, client computing, and gaming. It's slower, it's more methodical, but it's also more resilient. Now let's talk about the elephant in the room: margins. AMD is sitting pretty with a 54% gross margin. SMCI? They've been squeezed down to just 3.7%. Think about that for a second. For every dollar of revenue SMCI brings in, they're only keeping 3.7 cents as operating profit. AMD is keeping 54 cents. But wait, you might say SMCI is growing so much faster. True, but here's what worries me. SMCI is essentially using expedite costs to win business. They're paying a premium to get components faster and beat competitors on deployment speed. The problem? They can't pass those costs to customers because the pricing power sits with the hyperscalers. So SMCI is trapped in a razor-thin margin business where any hiccup in the supply chain or slowdown in demand could be catastrophic. Meanwhile, AMD has been steadily improving their margins, despite taking a $360 million inventory charge for regulatory issues. Their efficiency is actually getting better while they're growing. Here's something most investors miss. SMCI has 63% of their revenue tied to a single Tier 1 hyperscale customer. If you've been following the tech news, you know that's likely Meta or Microsoft. Now imagine you're building a business, and 63% of your income comes from one client. How comfortable would you sleep at night? One budget cut, one shift in strategy, and suddenly SMCI's growth story evaporates. AMD, on the other hand, has a beautifully diversified revenue mix. Data center revenue is strong, but they're also crushing it in gaming, with Ryzen processors driving 37% growth in client and gaming segments combined. This isn't just smart business, it's survival insurance. Let me show you something that gets me excited about AMD's future. They're partnering with SMCI in what I call a silicon meets metal strategy. AMD provides the brain, their Instinct MI308 and MI440X GPUs, while SMCI builds the body, the rack-scale infrastructure. Together, they're competing against vertically integrated players like NVIDIA. What does this mean for you as an investor? It means AMD gets the benefits of SMCI's rapid deployment without the risks of thin margins and customer concentration. They're playing chess while others are playing checkers. And here's the kicker. This partnership is reducing hyperscaler deployment time from months to weeks. That's a genuine moat. AMD isn't just riding the wave. They're building the platform for the next decade. Their Helios platform is designed for Yada-scale computing. If you don't know what that means, think of it as the architecture that will challenge NVIDIA's dominance in the GB200 market. They're also sitting on $2.1 billion in free cash flow and have $10.55 billion in cash reserves. That's not just a war chest, that's the fuel for aggressive R&D. In Q4 alone, their data center segment generated $5.4 billion in revenue, with the Instinct MI308 bringing in about $390 million from China alone. China! Despite all the export restrictions and geopolitical tensions, AMD is still finding ways to grow in one of the world's largest markets. Now let's flip to SMCI's game plan. They're all in on rack-scale velocity and total cost of ownership. Their DCBBS, that's Data Center Building Block Solutions, are modular clusters that include energy management. And here's something interesting. 90% of their Q4 revenue came from AI GPU platforms. They're laser-focused. But here's my concern. They're also planning manufacturing expansion in Malaysia and the Netherlands. That takes capital, lots of it. And with margins at 3.7%, where's that capital coming from? They're essentially burning cash to grow, betting that they can reach double-digit profit share next year. That's currently sitting at just 4%. Do you want to bet your retirement savings on that? Let's get real about risk. AMD faces moderate risk. Their biggest concern? Export restrictions, particularly around the MI308 chips. And yes, there's some softness in the gaming segment. But here's the thing. These are manageable risks for a company with a $10.55 billion cash cushion. SMCI, their risk profile is high, sky high, binary risk to be precise. Customer concentration at 63% means if that one major client sneezes, SMCI catches pneumonia. Their 3.7% operating margin means zero room for error, no pricing power. And their reliance on expedite costs means they're constantly playing a dangerous game. One supply chain disruption, one slowdown in AI capex, and the whole house of cards could tumble. So, where's the market right now? SMCI's stock jumped 13.35% on their $40 billion revenue guidance. The market loves a good growth story. But AMD? The stock has been under pressure, weighed down by broader sector concerns. But here's what sophisticated investors are watching. AMD's 1 gigawatt infrastructure joint venture with Cisco and Humane. This is a long-term catalyst that the market is currently ignoring. While everyone's chasing SMCI's explosive growth, they're missing AMD's strategic positioning for sustainable dominance. Here's the crucial pivot point that will define these companies' futures. SMCI needs to diversify away from their hyperscale dependence. They need to move from being a volatile, low-margin integrator to building a stable, broad-based enterprise business. Until they prove they can do that, SMCI remains a high-beta stock unsuitable for conservative portfolios. You're essentially betting on AI capex staying red-hot indefinitely. Are you confident in that bet? AMD, meanwhile, is building a fortress, strong financial foundation, diversified revenue streams, strategic partnerships, record-free cash flow. This is the company that will thrive whether AI spending explodes or cools down. Let me give you my tactical and strategic thesis. If you're a trader with high risk tolerance, SMCI offers explosive upside potential as long as AI capex remains unchecked. Bull case, the stock could hit $48. Bear case, it could crash to $26. The range is massive because the uncertainty is massive. You're riding a rocket that could explode or reach orbit. For SMCI, we're talking about exposure to the AI build-out sprint. You get immediate growth momentum with their $40 billion FY26 guidance midpoint. But remember, it's fragile. One wrong move, and you're underwater. AMD is a completely different story. This is the marathon play, the strategic thesis for long-term investors and conservative portfolios. Bull case? We're looking at $210. Bear case? Around $155. The range is much tighter because the business is much more stable. AMD is the sustainable beneficiary of the entire AI cycle. They're not betting on one customer or one product line. They're building the infrastructure that will power computing for the next decade. With their strong financial foundation, $10.55 billion in cash reserves, and record free cash flow, they're not just surviving the AI revolution, they're architecting it. So here's my final expert verdict. For exposure to the AI build-out, SMCI for the sprint, AMD for the marathon. If you're looking to capture immediate explosive growth and you can stomach the volatility, SMCI might have a place in your portfolio. But if you're building wealth for the long term, if you value sleep at night over checking stock prices every hour, AMD is your answer. Remember, the market rewards patience. AMD's diversified approach, improving margins, and strategic partnerships position them as a financial fortress, ready to fund the next decade of compute innovation. Before you go, let me be crystal clear about something. This video is for educational and informational purposes only. Nothing I've said here constitutes financial advice, and I'm not a licensed financial advisor. The stock market involves risk, including the potential loss of principal. Past performance doesn't guarantee future results. Before making any investment decisions, you should conduct your own research and consider consulting with a qualified financial professional who understands your personal financial situation, risk tolerance, and investment goals. SMCI and AMD are both volatile stocks, and their performance can be influenced by factors beyond the analysis presented here. Always invest responsibly and never invest money you can't afford to lose. If you found this analysis valuable, smash that like button and subscribe to Smart Stock Sam for more data-driven investment insights. Drop a comment below. Are you Team SMCI or Team AMD? I want to hear your perspective. And remember, in the market, it's not about being right once. It's about being right consistently. See you in the next one.